Hello and welcome to this special chat with kind of the man of the moment, Koushik Chatterjee, the head of finance at Tata Steel. The company, of course, has come into the limelight after it announced on Friday last week that the JV with ThyssenKrupp has been called off. Koushik, thank you very much for joining.
Thank you.
Well, first up, let me look at the math for Tata Steel Europe itself. Putting various brokerage reports together, it appears that the EBITDA per ton over there is about $42 as of now per ton, and at 50 you all are cash flow positive. Can you all bridge that? Can it stop being a bleed?
So, Latha, I think since you've started off clearly on the focus on the numbers, and I think I would like to explain that last year we had a significantly challenging operating year because we had our blast furnace down in Port Talbot for about 3-4 months. We had some issues in Netherlands and so on. I think actually if you look at it from a EBITDA per ton perspective, 50 is not our target, it's much beyond.
No, you all did 59 also.
Yes, correct. So I think our more sustainable target for Europe is around $70 to $75. And that's the target. And for that, we have been making investments in Netherlands. Netherlands going through a STAR program, which is precisely to make the assets much more capable to meet the highest requirement of the market. Similarly, in Port Talbot, we now have 2 stable blast furnaces. We have also invested in the midstream and downstream. So I think if you target a much higher number, it's par for the course, actually.
It'll pay for itself.
Yeah. So I think fundamentally we would, and I want to talk about the part that you started with, yes, the JV issue. The JV was constructed assuming all 3 hubs will be significantly cash positive, and that's where the synergies were coming in. And when I say 3 hubs, it included the Thyssen hub. Okay. So I think it is very clear for us that Europe would be a cash neutral entity, and it is not a load on Tata Steel's India.
By when?
So I think it is this year's plan. So I think in the next 12 months you would see that. You know, I think there are huge amount of plans and actions being driven to calibrate cost takeouts, to calibrate capex, and manage working capital much leaner. Okay. We've actually done fairly good work in working capital in the last year. I think capex, as I said, that the blast furnace required an unplanned capex injection. The capex out of the STAR program in Netherlands is going to wean out, and therefore I don't see any anxiety that Europe will be bleeding. You know, the general perception, yes, people start with in the conversation.
So it's even otherwise, I mean, from the math that many people have done, it's only $8 per ton, if that. Correct. But you're saying that by end of FY20,
we should be over that, yes. We will have. So we have been working irrespective of the JV, because end of the day we would have owned 50% of the JV too.
Yes.
So it's always be an element that you have to address, and therefore we had started that work. Okay. It is part of the works, and it'll get done.
I'm just sticking to the math because you know the market is trading and they want to know these numbers.
Yeah, sure.
See, there is a capex you have done of about 350 million.
Correct.
US dollars for
more than it's pounds.
Okay. Sorry. What is the capex this time? I'll tell you why. The market broadly has taken away 50 rupees from your share for the JV not coming through.
Correct.
Now you're telling us first that the losses itself are going to be reduced and the free cash flow could turn positive or at least break even this year.
Certainly.
So they may probably put back a few rupees on that. Now I'm asking you about capex and interest outgo. Yeah. How does that work out in the current year?
So if you look at the sustainable capex, that's in the region of say 200 to 225 million pounds. Okay. We've been doing a program to make the capex more targeted and focused in terms of meeting the market requirements for the future, specifically for automotive grade. In fact, one of the reasons why the European Commission has been actually taking us much more seriously, because they're saying you are a strong automotive guys, you know, so that needs to be also reflected upon. So that CapEx program was taken on board, and we have spent substantial part of the CapEx. Last year we spent about 330 odd, and I think this year also will be somewhere around the similar number.
Okay.
You know, so there, you know, the CapEx in Europe is not like CapEx in India.
Yes.
India is a growth CapEx. There it is more value CapEx.
Of course.
So that's what the focus is.
Okay. So now let me come to the debt burden itself, which is another reason why some money is taken off some of the parts for Tata Steel.
Correct.
And that is, you know, out of this 95,000 crore, the expectation, or 93,000 crore, 20,000 crore was expected to be, or $3 billion was supposed to go, 18 to go to the JV.
Yes.
Now that's not happening.
Yeah.
Therefore, how does that change the math for your debt itself? Is there any other plan you have for debt reduction other than the $1 billion you've already promised?
So, you know, the point is that this 18,000 would have got deconsolidated as the JV would have happened. Now, there are two things. Before I answer that question, the point is that JV not happening and life as usual is not the answer.
Okay.
That needs to be also be understood.
Yes.
That it is, so two things I would, if I may just jump forward. The JV had two targets from a Tata Steel point of view. A, to build a more sustainable business portfolio, which would be, in our view, actually would have served the competition well, would have served the sector well, customers well, and climate well. You know, these are the four things. So that not happening, the strategy doesn't change. There are other alternatives strategically. We will be open to those alternatives, and we've already started working on those. And I think there will be a time not too long from now when we will articulate that in the market. In the meanwhile, the point that you mentioned is relevant, which is that how do you move to cash neutrality, and there is no additional support required from anyone else, and it is kind of a self-sustained ring-fenced business, and that's what we've been working on, and that's what it's largely been there in the last quarter. We've seen that, and we will continue that effort in the next few quarters. And if I may say, this is the interim step before we have the newer scenario.
Yeah, I was toying with the idea whether to ask that question first or this cash burn or interim issue first. Okay, the final scenario. What is the plan B? It looks like you cannot have buyers in Europe because everywhere there will be an issue of, even with Ilva and Arcelor, the EC was creating the same or asking the same questions. So I don't know, will you really have other buyers in Europe, or are you talking to a Chinese buyer or buyers outside?
So without getting into specifics at this point of time, I think again, as I said, what was our starting point? We said that European steel industry is different compared to India. It focuses more on, it's more matured, and it focuses on value rather than volume. And we had a potential partner with whom the synergies would be very high. I think there are options to look at partners both within Europe and outside Europe, and there are options to look at other players who would share the same industrial logic as we would be, and those conversations have started. So I think we would continue to have these conversations. It takes a long time to sometimes seed, depending on how the structure is. But I think we are open to ensuring that our end game strategic outlook remains the same. And the deleveraging or deconsolidation, more appropriately, was more as an outcome or as a consequence than the only driver. Because if you, so for example, like the reason why I want to say this is that you deconsolidate, okay, fine, and then you have a bad outcome or you have a painful period, it doesn't work. So you have to look at the fundamentals first, and this is a outcome.
The deconsolidation also would have been cash positive,
correct.
Is what you're
Absolutely. And then you look at where does the overall Tata Steel look like. You know, if you are talking about EBITDA numbers of say between 25,000-30,000 crores, and if you have a debt of roughly 90,000 crores, that's
So
three times. And 3 times debt in a steel industry or a commodities industry is not crossing the line, so to speak. And mind you, we've just bought Bhushan Steel,
Yes.
and the integration is well underway. We are getting a lot of synergistic value
Absolutely.
in the market as well as in the costs. We've just got Usha Martin, it just started. We believe that while it may be small, 1 million tons, but we will drive the same. And then you're talking about Kalinganagar expansion,
Yes.
starting to get commissioned in the next, starting to get
Yes.
in 18 months to 24 months and so on. And then you have another 5 million tons of great asset coming on board. So the de-risking plan is actually being worked on an underlying basis, where this 18,000 crores was not the primary driver, the sustainability, and we were looking at more value from what would have been a great joint
Actually,
venture.
that was going to be the next question. If you can put it in numbers, you know, when you first took over Chorus, that was the one that was wagging the company.
Absolutely.
I mean, as a percentage.
Correct.
Now, actually, it is a much smaller
It's a
part
much smaller.
of the whole.
There are now.
So, can you give us the percentage? What was it when you took over?
Yeah.
What is Europe as a part of your total now in terms of EBITDA? And where do you see it, say, 2 years down the line and 3 years down the line?
So if
What
you,
I mean is when Kalinganagar is done.
Yeah, so if you look at around 2006, 2007, first from a physicality point of view, we were 4 million tons, Chorus was 18 million tons.
Yes.
Cut to today, we are 18 million tons, Chorus is 10 million tons. We would be 24 million tons in say about 2 years from now. Okay,
Correct.
so and they would be, or Chorus would be, or rather Tata Steel Europe would be about 10.5 million tons. So the physicality is different. Now, if you look at from a profitability perspective also, last year we had about a 15,000 rupees ballpark average EBITDA per ton. And at a peak of about 18,000 in quarter 3, quarter 2, quarter 3. So I think if you look at it, all weather EBITDA at 15,000. Okay. Take the ups and downs and do it on that basis. And even if I take a $50 that you talked about for 10 million, you see the proportionalities are actually 2/3, 1/3.
Yes.
You know? And this 2/3 is going to become bigger 2/3 because it will move towards more 70%. Yeah, three quarters. And then if you have a ring-fenced business in terms of operating cash flows, working capital, capex, etc., then actually this becomes a very small part of the portfolio. So if I look at the main hubs of Tata Steel consolidated, Jamshedpur, Kalinganagar, Angul, 3 in India, Netherlands, IJmuiden, and Port Talbot, you have at least 4 of the 5 hubs as world class.
We need to take a break on that note. We are coming back with lots more questions to Koushik Chatterjee.